Wise. What stock markets earnings and the chances for a soft landing for the economy? Joining us now with more is Liz Young, head of investment strategy at SoFi. Any change to your sentiment after watching what has been a pretty solid January so far, Liz? Just a sort of a relief rally, is that all?
Look, it has been a solid January, and it's been surprisingly resilient in the face of a lot of economic data that's pointing towards a slowdown. And that's not something that we can ignore, right? And I've sharpened my pencil many times already this month and looked at it and tried to say, all right, where could I be wrong? Where could I be missing something? Do I still want to be cautious? And the answer continues to be yes, I still want to be cautious. I recognize that there are some bright spots. There are still bright spots in the economic data, although they're waning. And there are some bright spots in earnings. But if you just look at the broad data so far on earnings, the number of companies beating is below all of the longer term averages. So earnings are not really all that impressive, especially considering that we've already revised them down. So if we're beating at less than average rates on estimates that have already been revised down, that's not a great outlook. And then there's a lot of leading indicators in the economy that you have to watch as well. So I'm still cautious. I still think that the economic data and the blowback from this tightening cycle has not been seen entirely.
So what does that mean for someone in your business, Liz? Are you looking for an entry level 10% below where we are? If you knew that was going to be the extent of it, and then we were going to be back in a better market, wouldn't you just buy now anyway, buy the names that you like and buy more if you were correct about another 10? Or do you think you're going to get a chance to buy things 20% cheaper? What goes into your calculus there?
I don't know that we'll get a chance to buy 20% cheaper. And part of that is we came into this hiking cycle and this tightening cycle with a lot more bubble wrap around markets and around the economy than ever before. So it may not go down as deep as average recessions in the past or average bear markets in the past. However, if you are looking over the long term, sure, you could buy now. Everything was down quite a bit in 2022, and a lot of those high growth names down a lot. And I would suggest that there's probably parts of the NASDAQ and parts of the tech indexes that have bottomed. So you could enter now, but you have to enter now knowing that there's a high probability that things likely get worse again before they get better. So if you're going to enter some of those growthy areas, I think it's okay. Things like software, cybersecurity, that's okay. But then close your eyes for about 6 months and make sure that you're not having knee-jerk reactions to some of this market volatility. Now, if you're trading and you're trying to find a 2 to 3 week upside, I don't know that this is the right entry point. We've got 18 times forward earnings on the S&P again, and a NASDAQ that's up almost 10% year to date. That feels a bit overly exuberant to me, and I want to get through the tech earnings from next week before I would say that we should enter.